G'day Gain Squad, it is your mate from Goldie Gains here, and we are looking at a proper ripper of a market session today. Jump up and under, let's get into it and see where the smart money is flowing today. In this update, we are covering the massive tug of war between $4,500 gold and $100 crude oil. We are also diving into the tech wreck for the Magnificent Seven and how the Strait of Hormuz crisis is redrawing the global macro map. Plus, we will break down the local Aussie dollar slide and check if the technical indicators are finally signalling a proper golden entry. Before we optimize this entry, remember this isn't financial advice, it is just for education, so do your own research, traders. The big question for today is, has gold found a rock-solid floor at $4,500 or is the markets having a bit of a wobbler? Do you think we are prepping for a launch back to $5,000? Or is there more pain in the pouch for us gold getters? Let me know your predictions in the comments below. And if you find this ripper, don't forget to smash that like button. Subscribe to Goldie Gains right now to stay in the loop with the smart money and never miss a beat of this hectic market. The geopolitical heat is absolutely soaring as the conflict in the Middle East enters its 5th week with no clear end in sight. President Trump has officially pushed back the deadline for Iran to secure a peace deal until Monday, April 6th, 2026. While he is talking about serious discussions with a new regime, he is still threatening to obliterate Iranian energy infrastructure if a deal fails. Iran has already rejected a 15-point plan, demanding total authority over the Strait of Hormuz, which is a massive non-starter for the West. This high-stakes poker game is keeping the safe haven bid alive, but the soaring energy costs are creating a very complex stagflation trade. If the strait is blocked, we are looking at 20% of the world's oil supply going poof, which would be a total macro shock. Traders are watching the news feeds like hawks, because one wrong move in the Gulf could send all our charts into a proper tailspin. For now, the market is pricing in a wait-and-see approach, but the underlying tension is thick enough to cut with a knife. Gold is sensitive to every headline right now, bouncing between $4,480 and $4,532. It is a wild ride, and we need to stay focused on the facts while the politicians do their jawboning on social media. Let's talk about the black gold, because West Texas Intermediate, or WTI crude, is trading at a hectic $101.80. Oil has surged 40% since this conflict started, and on Monday, March 30th, it hit an intraday high of $103. The OVX, which is the crude oil volatility index, has skyrocketed to 96.64, reflecting absolute chaos in energy markets. Compare that to the gold volatility index, the GVZ, which is sitting at 45.51. It shows where the real fire is burning. Higher oil prices are feeding straight into inflation, making the Federal Reserve in the States much more likely to keep interest rates high. Prediction markets are currently giving 74% odds that WTI will cross $105 per barrel this week. As long as energy stays this expensive, gold faces a major headwind because it does not pay any interest to hold it in your portfolio. We are seeing a negative correlation where oil goes up and gold gets squeezed as traders prepare for a more hawkish Fed. It is a classic liquidity event where funds are dumping what they can to cover their rising costs elsewhere in the global system. Let's see where the smart money is flowing today, and right now, a lot of it is hiding in the US dollar and energy futures. Closer to home, our local Aussie dollar currency pair is looking a bit bruised, sliding down to a 2-month low near 0.6850. The Aussie dollar hit 0.7187 earlier in March, but the global risk-off mood has dragged it down since then. On the share market, the ASX 200 index finished Monday down 0.6%, closing at 8,456. For the whole month of March, the ASX 200 has slumped more than 8%, which is a proper gut punch for local investors. The Reserve Bank of Australia is in a tough spot with sticky inflation, and economists reckon another rate hike in 2026 is possible. Higher energy prices are expected to fuel local inflation and slow down our economic growth, which is why the market is feeling heavy. Major banks like CBA and Macquarie have been slipping lately as the market reassesses the risk of a domestic slowdown in Australia. Traders are looking ahead to the RBA minutes and the US jobs data on Friday to see if we can get a bit of a bounce. When the Aussie dollar is weak, it usually makes gold priced in our local currency look better, but the global sell-off is dominating. We are keeping our eyes on the 0.6770 level for the AUD, as that is the next major structural floor to watch. Even the big dogs are feeling the heat, as the Magnificent 7 tech stocks in the States have officially entered a correction phase. Microsoft has taken the biggest tumble, falling approximately 32% from its peak, reached back in October of 2025. Meta is down 25% and Alphabet has shed 15%, as the initial AI enthusiasm starts to meet some real-world friction. A Bloomberg index of these tech giants shows they are all down double-digit percentages from their recent 52-week highs. Institutional investors are rotating their cash out of high-valuation tech and moving it into energy, industrials, and domestic manufacturing. This massive rotation is creating forced selling in gold, as funds dump their liquid assets to rebalance their portfolios during the tech slide. It is not that the tech story is dead, it is just that the market is repricing the Magnificent 7 for a higher interest rate environment. Nvidia and Amazon are also trading in the red for the year so far, which is a massive shift from the moon mission we saw in 2025. Some analysts are even drawing parallels to the dot-com era, warning that valuations have finally hit a wall of reality. But for us, this rotation into hard assets and energy is exactly what we want to see for the long-term gold bull case. Let's look at the red metal, because copper is currently trading around $5.46 per pound on the COMEX. Copper has fallen about 7% over the last month, even though it remains about 9% higher than it was a year ago. The copper to gold ratio has dropped to 0.000076, which is a classic signal of industrial caution. Usually, when copper is weak compared to gold, it suggests that the global economy is bracing for a bit of a slowdown in building. However, there is a silver lining. Demand for copper in AI data centers is accelerating rapidly, with JP Morgan expecting huge growth. Mining giants like Rio Tinto have even pushed back new copper projects, which means supply is going to stay very tight for years. In the short term, copper is sensitive to the Middle East conflict and shipping disruptions, just like everything else in our pouch. If copper can find support near $5.39, it might signal that the global industrial cycle is bottoming out. For now, the market is treating copper as an industrial proxy that is being weighed down by energy-driven inflation and high rates. It is a proper balancing act, and we are watching the $5 psychological level as the ultimate floor for the red metal. The de-dollarization narrative is hitting a fever pitch, with the BRICS nations announcing a new blockchain-based payment system. This system is designed to compete directly with the US dollar and allow nations to settle trade without using the SWIFT network. Russia and China are leading the way, reporting that 99.1% of their trade is now settled in rubles and yuan. Iran is also pushing for oil settlements in yuan, leveraging its position in the Strait of Hormuz to force the hand of energy importers. If the petrodollar system keeps fracturing, gold will be the only neutral reserve asset that central banks truly trust in a crisis. We are seeing a structural shift where the dollar is being de-risked by nations from Asia all the way to South America. While the DXY index is still holding near 100, the long-term foundations of dollar dominance are looking a bit shaky. Trump has threatened tariffs on BRICS members who try to bypass the dollar, adding even more spice to the geopolitical mix. But for the gain squad, this is the ultimate tailwind. More global instability usually leads to higher demand for the shiny stuff. It is a multi-decade trend, not a one-day wonder, so we are keeping our eyes on the big picture while the headlines scream. Even the legendary billionaire investors are sounding the alarm on the US fiscal situation and what it means for our portfolios. Stanley Druckenmiller is worried that the Federal Reserve has declared victory over inflation way too early in this cycle. He calls gold a 5,000-year-old brand and is sticking with it because he doesn't trust the central banks to hold it together. Paul Tudor Jones is even more blunt, saying that all roads lead to inflation because of the massive US national debt levels. Jones thinks the Fed will be forced to keep rates low eventually to help the government pay its bills, which would spark more inflation. Both these legends are betting against US Treasury bonds, which they reckon are priced completely wrong for the coming years. When the big money starts worrying about sovereign debt, they historically pile into gold as the ultimate insurance policy. We are also hearing from Robert Kiyosaki, who is predicting gold could eventually hit $35,000 an ounce in a collapse. While that is a bit of an extreme scenario, it shows you the level of concern among the hard money crowd right now. If the smart money is hedging against a bond market disaster, we should definitely be paying attention to our own allocations. Over on Reddit and Wall Street Bets, the sentiment is a wild mix of buying the dip and searching for the next massive short squeeze. Traders have noticed a huge gap on the COMEX between paper open interest and the actual physical gold registered in the vaults. We are talking about 222 million ounces of paper gold versus only 88 million ounces of the real physical metal. The YOLO crowd is betting that if even a fraction of those paper holders demand physical delivery, the price will go parabolic. Sentiment on the r/stocks forum is also noting a historic divergence between gold's 8-month winning streak and the SP 500. Some retail traders are starting to shift into defensive mode, picking up GLD and silver as a hedge against a broader market crash. There is a lot of copium in the threads about the recent 20% drop, but the long-term bulls are still holding their ground. On Polymarket, traders are pricing in a 70% chance of further US military action before the northern summer begins. This retail fear factor is a key ingredient for the next leg up, as it shows the market hasn't reached a state of total euphoria yet. The market's having a bit of a wobbler, but the Reddit crowd is ready to diamond hand their gold positions until the end. The macro calendar for the start of April is looking absolutely packed with events that will move our gold and oil positions. We are waiting for the US non-farm payrolls report on Friday, April 3rd, which is the big daddy of economic data releases. If the jobs numbers come in hot, gold might take another dive toward 4,100 as the Fed stays hawkish. But a weak jobs report could be a proper catalyst for a rally back toward the $4,800 resistance zone. We also have Eurozone inflation data and China's latest PMI figures coming out, which will tell us how the global economy is faring. Back home, the RBA will be releasing their meeting minutes, giving us a clearer view of our own interest rate path here in Oz. It is quarter-end rebalancing time for the big funds, which often leads to some funky price action and sudden spikes or dips. Traders should stay light on their feet this week and keep an eye on the clock, especially with Good Friday holidays coming up. Volatility is the name of the game right now, and the macro calendar is the roadmap we need to navigate the storm. Let's optimize this entry by knowing exactly when the big data is dropping and how the market is likely to react. Despite the recent correction, the big banks on Wall Street are still keeping their eyes on the prize for gold in 2026. JP Morgan is targeting $6,300 by year-end, based on massive central bank buying of 800 tons. Wells Fargo has also raised its target to between $6,100 and $6,300 per ounce. Even UBS is in the bull camp, aiming for $6,200, with a possible upside scenario of $7,000. They see this 19% drop as a healthy correction that clears out the speculative froth and sets up the next leg higher. Most analysts agree that as long as the structural reasons for the bull run remain, the current price is a bargain. Let's look at the technicals, as gold is currently holding a key neutral zone around the $4,500 level. We had a nasty death cross on the 4-hour chart on March 25th, which is still acting as a bit of a momentum killer. The 14-day RSI is sitting around 39, which means the panic selling has paused, but we aren't overbought yet. Key resistance is sitting at $4,668, which we need to break to flip the bias back to bullish. On the downside, the 200-day exponential moving average near 4,200 is the line in the sand for bulls. We saw a hammer reversal pattern on the 4-hour chart near the lower Bollinger Band, suggesting buyers are finally stepping in. If we can sustain a close above 4,538, it might signal the start of a sideways consolidation range. This is a proper golden entry if we hold these support levels, but stay cautious until we see a clean break of resistance. To summarise, gold is consolidating near 4,500, while oil sits above $100 on war fears. The Strait of Hormuz crisis is the main driver for energy volatility, with the OVX index hitting nearly 97 today. Tech stocks are in a correction, the Aussie dollar is at a 2-month low, and the global de-dollarization trend is accelerating fast. Famous investors like Druckenmiller and Jones are hedging against US debt, keeping the long-term case for gold very strong. Technicals show we are in a coiled basing pattern, waiting for a breakout above the $4,600 level. Institutional targets remain high at $6,000 plus, even though the short-term paper market is having a proper wobbler. The big question remains, are you buying this dip or waiting for the US jobs data to clear the air on Friday? I want to see your trade plans in the comments. Are we looking at a bounce or a break of the $4,000 level? If you enjoyed this macro deep dive, give us a like and subscribe to Goldie Gains for your daily dose of market alpha. Keep your positions tight and gains golden. I'll see you at the next close. Cheers! Stay active, stay legendary. Catch ya.